Hello, it's Bob Steele. In this lecture, we will continue on Chapter 10. We're now looking at the depreciation methods. And once again, I want to just put us into context, look at the trial balance and see where we are at in terms of what accounts we're focusing in on. And so remember, we're drilling down on these property, plant, and equipment like land, equipment, and accumulated depreciation. It's in the asset area. If we're looking at the trial balance, which assets are on top in the green in this case, they're usually debit balances with the exception of accumulated depreciation, which is what we will be looking at this time. And so that is the context in which we are taking a look at the property, plant, and equipment. So the lump sum purchase, first we want to take a look at if we purchase multiple items at one time. So the total cost of combined purchase of land building is separated on the basis of their relative fair market values. So we could buy things at one time. So we might buy multiple different fixed assets at one time. And the question is, how do we allocate between these things? So for example, CarMax paid $90,000 cash to acquire a group of items consisting of land appraised at $30,000. So when we pay for it, we bought $90,000, and it has land involved in it and a building and some other items here. And notice when we buy land and a building, again, it's not going to say in the purchase price, this is how much you bought the land for and this is how much you bought the building for. We could have an appraisal in order to figure that out, is one way that we can do this. The appraisal may not tie out to the purchase price exactly every time. So the problem is we bought it for a certain amount and we're trying to allocate between these items, being land and building, and we're trying to figure out how to do that. We're going to do that with an appraisal, which doesn't tie exactly out to the purchase price. So we're saying the land appraised for $30,000, land improvements for $10,000, and the building for $60,000. So if we take a look at that, the 30 on the appraisal and the 10 and the 60 add up to 100. We only paid 90 for it. So what we can do is come up with a ratio. We use ratios a lot when measuring a lot of different things. So if we take the 30 compared to the 100, that's 30% land. 10 compared to the 100 is 10% improvements, and the 60 compared to 100 is 60% on the building, or 90. So in some way, when we get a lump sum purchase, we're going to have to break it out between these separate categories. Okay, so compute the amount recorded as the cost of new machine given the following payments related to the purchase. Gross purchase price was $70,000, sales tax $49,000, purchase discount taken $21,000, freight cost are $3,005, normal assembly $3,000, cost necessary for machine platform $2,005, cost parts used in maintaining the machine. So if we look at those, once again, the question is, should we be expensing these things or should we be including them in the cost of the asset? And of course, we're going to include the sales price. And if we take a look at the rest of them here, we got the gross price. We're going to obviously include that in the cost of the asset. Sales tax. Once again, we paid the sales tax on the machine, the asset, which we're going to use in the future. So we do need to include that in the cost of the asset. The purchase discount, if we're not actually paying the $700, but we're saying $700 minus 21, then we have to pull that out, minus the purchase discount. Freight costs, if we're paying the freight costs in order to help us install the equipment, we need to include that in the cost of the equipment. Normal assembly, once again, if that's needed to put the equipment into use, we need to put that in there. Necessary platform, if that's needed for our equipment, then that's going to be included in the cost of the equipment. Costs of parts used in the maintenance. Notice that's maintenance. So now if we're saying that we need an oil change of the machinery every once in a while, that is no longer the cost of us purchasing the equipment. That's maintenance and therefore will be expensed as we do the maintenance. So such as if we bought a car, obviously the cost of the car would be different than the gas and the oil, which we would expense as used. Okay, so then the total cost comes out to the $737. So depreciation. Depreciation is the process of allocating the cost of a plant asset to expense in the accounting period benefiting from its use. So that is the matching principle. That's the accrual principle of when we buy the equipment. Once again, we have not yet used it, therefore we're going to put it on as an asset rather than an expense. Then once we use the asset in order to help us achieve our goal of revenue generation, we take it from the asset and expense it in the time period in which it helped us generate revenue. We're going to have to use estimates in order to do that. So factors computing depreciation. A calculation of depreciation requires 3 amounts for each asset. So in order to calculate depreciation, we need to know the cost. We need to know the salvage value. That means that's what we can sell it for at the end of its estimated useful life. So if it's a forklift and we think the forklift is going to be used for 5 years, the end of 5 years, it's going to be worthless, but we can at least scrap the machine for a certain amount. That scrap is what we think is the salvage value. Sometimes the salvage value is 0. We just won't have a salvage value. Useful life. How long will the machine be in service for? So if you were going to do this, if you're going to say, I have this piece of machinery, it cost me $10,000, and I need to allocate that $10,000 over the useful life, and you were to think about how could I do that, the first thought that probably comes to most people's mind is, well, if I'm going to have it for 10 years, I can just take the cost divided by 10 and allocate an even percentage over its useful life. That's what we call the straight line method. That's the easiest method to kind of think about and use. On the other hand, another method that could be used is the units of production. That means that it could be something more efficient, such as if we had a car and we depreciated it over its useful life. We said it's going to be used for 5 years, and so we'll just divide by 5 and depreciate it over 5 years. But maybe it would be more efficient to say, well, I think it's going to be used for this many miles, and then depreciate it based on how many miles. We'll divide out its useful miles life, and then each year we'd have to track how many miles we drove and allocate depreciation based on miles. That might be more effective. It's a little bit more difficult to calculate than just using time. So the third method is called the declining balance method. And what we're going to do there is we're going to say, well, the straight line allocates the cost evenly over its useful life. But it could be argued that we use the machinery to generate more revenue in its early years, and in its later years it's not as efficient. Therefore, it should be reasonable for us to expense more of the cost of the machinery in its early years rather than its later years. And that would be a form of declining balance. That also makes our revenue lower, which happens to be good for taxes. So the declining balance method is often a preferred method for companies if they're trying to lower their income for taxes. So we have the straight line method. If we calculate this, we have the cost here, the salvage value, that's what it costs at the end of the useful life. That's the depreciable cost, the 10 minus the 1. The useful life, in this case, 5 years. And we don't really need the units in this case because that would be for a different method. So we're going to take the cost minus the salvage value. So at the end of the 5 years, we want the book value to be this 1,000. Therefore, so we're going to take 10 minus the 1, giving us the 9. Then we're going to divide that by the useful life, the 5 years. And that means we're going to depreciate or lower the cost from 10 by 1,008 each year for 5 years, which will leave us with the salvage value at the end of the 5 years of 1,000. The way we record the depreciation is, remember, depreciation expense. All expenses have debit balances. They only go up for the most part. How do we make something go up? We do the same thing to it, which in this case is another debit. We increase depreciation, and then we must credit accumulated depreciation. Accumulated depreciation is a contra asset, and therefore it has a credit balance. If we credit it again, it'll make the contra asset go up, which will make the book value of the asset go down, because the book value is calculated by the cost minus the accumulated depreciation. Accumulated depreciation goes up, bringing the book value down. We're writing down the asset, we're expensing the item. So if we looked at this type of chart, we're going to say the straight line method will have an even amount of depreciation over 5 years. And the asset's book value will decline at an even rate over the 5 years until it's at that $1,000, which is the salvage value. If we look at it in terms of a table, we can say here's the original cost when we bought it, and then in 2015 we're going to say the depreciation rate is 20% because it's a 5-year property, and so if we calculate the percent on that, it would be 20%. we're going to take the 1,008 per year. Therefore, the accumulated depreciation is 1,008, and the 10 minus the 1,8 gives us the 8,2, and the cost is still the 9,000, and once again, 20% is always the same, 1,8, and so now we have the accumulated depreciation, which is this number plus this number, and now we're taking the 8,2 minus the 3,6, brings us to the 6,4. Sorry, this is the total accumulated depreciation. So it's the original cost minus the 3,6 gives us the 6,4, and then we keep going down with this. Once again, the cost always remains the same. We have the straight line depreciation giving us the depreciation being the same. Accumulated depreciation plus the depreciation expense for 2017 gives us the 5,4 accumulated. The cost minus the accumulated depreciation gives us this. And we got the 9,000, one more year, accumulated depreciation prior year, plus the depreciation expense this year gives us the 7,2, and the 10 minus 7,2 gives us this. And we do this one more time, and we get to the 9,000. That's where we stop, because we can't go below the 1,000, the salvage value that we think we're going to sell it for at the end of its useful life. So units of production, what we're going to do is we're going to take the cost minus the salvage value, and instead of dividing it by its useful life in terms of time, we're going to divide it by its useful life in terms of the units that we think we're going to measure. We use the car and its miles as an example. It could be, if there's a printer, it could be the number of pages or something like that. And if we do a calculation such as this, we can say that the depreciation, in this case, we have costs minus the salvage value divided by the total units. So the 9,000 divided by the 36,000 units, that's how many units that this thing will be using over its useful life. That means we're going to get 25 per unit. Then what we need to do is we got to say, okay, assume that 7,000 units were inspected. So the inspection units is what we're measuring by during the first year. Then we're going to take the 25 cents times the 7,000 that we calculated the inspection units for that year. And we expect these inspection units to go up to 36 over its useful life, and therefore we're going to get 1,750 in that year. If we calculate this out, once again, we're going to have to come up with the number of units, which we're going to have to count each year. That's what makes this method a little bit more difficult, but perhaps more precise if we can find a good item that drives this method. Times the 25%, we come up with the depreciation expense, and we come up with a similar deduction here. Notice once again that we're always going to stop at the accumulated depreciation of 9,000 because the salvage value is 1,000. We can't go below the 1,000. If there was no salvage value, then obviously we can't go below 0. Doesn't mean the machinery is not still in use. It may be. We may not get rid of it after 5 years. Then our estimate was a little bit off. That's fine. We still can't make it a negative asset. So we got to stop at that point. Okay, so then we could use a double declining balance. So the way we do the double declining balance is we figure out the straight line rate. The way we do that is we could take 100% divided by the number of years. In this case, it was 5 years. 100% divided by 5, or just 1 divided by 5, will give you 20%. So 20%, if we double that, we get 40%. So what we're going to do is we're not going to calculate the salvage value. That's the tricky thing here. We're just going to take the cost, ignoring the salvage value, times the double declining rate, which is now 40%, and that gives us the depreciation in the first year. It'll be twice a straight line rate if we did not consider the salvage. We're still going to deal with the salvage, but what we're going to do is just make the salvage happen in the final year. So this isn't a precise math method, so if some people, that frustrates some people, because the last year what we're going to do is we're going to make it work. So let me show you how this happens. So what we're going to do is we're always going to take the book value times 40%, the double declining rate. That gives us our expense, and that reduces our book value. Year 2, we take our reduced book value, which is the 10 minus the 4, and we times the 40%, and that gives us the 2,4, and accumulated depreciation prior year plus the 2,4 gives us the 6,4. 10 minus 6,4 gives us the 3,6. 3,6 is the new book value times 40%, and we get a depreciation expense here, and so on. Notice the depreciation expense goes down each year because we're front loading the depreciation. The idea being that we get more use out of the equipment in year 1 than in year 5. And notice we have the asterisks here because we didn't take the 1,295 times 40 because we just made that number what it needed to be in order for this number to be 9,000 in order for us to end up at our salvage value. So this method does not work out perfect mathematically. It forces us to just make year 5 or whatever the final year is work. So if we look at the 3 methods then, the straight line has, of course, an even straight method over the useful life, meaning we're depreciating it evenly. Units of production might be the most precise if we decided on a good item to allocate the depreciation on, such as like miles if it was a car. And the double declining balance, you can see, heavily front loads it, which again, the net is always going to be the same, 9,000, 9,000, 9,000. But there is a timing difference. So if we took a look at the 5-year as a whole, then there would be no difference between the 3 methods. But from year to year, there could be a very substantial difference, especially between these 2 here. And what that means in this case is that net income is going to be lower in year 1 and higher in year 5, where in this case it's going to be even throughout. When would we want net income lower in the front years? When we do taxes oftentimes. So double declining is useful for taxes. Taxes usually uses a form of double declining, which is the accelerated cost recovery system. So the actual tax code generally for the most part uses an accelerating method much of the time.